So what exactly does the biggest landlord in the life sciences sector do when, all the public biotech companies suddenly just stop renting space?
Well, you'd think they'd panic.
Yeah.
Or at least just slash their prices and pray for the best.
Right, exactly. But what if they just quietly pivot? Like, what if they pivot hard to advance tech and AI infrastructure?
Yeah, and what if they actually start selling off their premier lab space, like at a massive loss, just to build up this financial fortress against a coming storm?
It's wild. Welcome to our deep dive, everyone. Today, our mission is pretty straightforward. We are taking the very dense, very jargon-heavy Q2 2026 earnings call from Alexandria Real Estate Equities, that's ticker symbol ARE, and we're just going to slice right through all that corporate speak for you.
Yeah, we're going to give you the talk tickers treatment, delivering the headline numbers, pulling out the actual mechanical story that's hiding behind all that data, and giving you a really actionable, opinionated bottom line. Like, is this stock a buy, a hold, or a sell?
Exactly, because Alexandria is just this fascinating case study right now. I mean, you have this massive company playing incredibly aggressive defense in a sector that is basically undergoing a tectonic shift.
It really is the ultimate defensive playbook, and they're executing it in real time. Because look, the broader U.S. economy has definitely had its quirks over the last year or so, but Alexandria's quarter, it really demands that we look way past the surface level earnings.
Oh, absolutely. We have to dig straight into the mechanics of their real estate, right? The lease rollovers and honestly, heavily into their debt leverage.
Yeah, we really need to get into the weeds of how real estate operates on a purely structural level to understand this specific quarter.
Yeah.
Because the top line numbers, they present this very specific, almost comforting, honestly narrative. But the underlying cash flows tell a much, much more complicated story.
Right. So let's just jump right into those headline numbers, because if you just glance at the top line, things actually seem, relatively stable.
On the surface, yeah.
Right. Their funds from operations, which for those listening, FFO is kind of the gold standard metric for REIT earnings. It came in at a solid $1.73 per share for the second quarter.
Just to clarify, that is on a diluted as adjusted basis.
Oh, right. Good catch. Hold on. Let's not just breeze past that phrase, because for you listening, if you're trying to build out your financial vocabulary, what does diluted as adjusted actually mean in practical terms?
It's a really critical distinction to make. So diluted basically means the calculation assumes that all the convertible securities, like stock options given to executives or convertible bonds, have already been exercised.
So it's basically the worst case scenario.
Exactly. It gives you the worst case scenario for how many slices the company pie is being cut into.
Yeah.
You always want to look at diluted earnings because it shows you your true piece of the company.
Right. That makes sense. And then the as adjusted part.
As adjusted just means the company stripped out all the one-time accounting noises, like, say, a penalty fee for paying off a massive loan early, or some sudden unexpected legal settlement. They adjust that number so it actually reflects what the recurring everyday business operations look like.
Okay, got it. So on that core everyday operating basis, they hit $1.73 per share, and they even reaffirmed their full year 2026 FFO midpoint guidance, which was $6.40 per share.
Right, and they tightened the range on that too, down to plus or minus 5 cents.
Yeah, which usually signals some pretty strong confidence from the management team, but then, and this is where things got a bit weird, on the call, management specifically flagged that their fourth quarter FFO is going to take a sudden dip.
A pretty noticeable one, yeah.
Yeah, they're saying it's dropping to the lower end of a $1.40 to $1.50 range. And they blamed this on, quote, lower capitalized interest. I'm going to need a translation from you here.
Yeah, so the accounting rules for real estate development can completely distort the bottom line that you actually see as an investor. Capitalized interest is honestly the perfect example of this.
Okay, break that down for us.
So when a company like Alexandria is out there actively building this massive state-of-the-art new lab facility, they are almost always borrowing money to pay for that construction.
Right. And obviously they have to pay interest on those loans immediately, right?
They do, yeah. But here is the accounting magic. Because the building is still technically under construction and it's not physically capable of generating rent yet, the accounting standards say, well, it wouldn't really be fair to penalize the company's current income statement with that interest expense.
Oh, interesting. So what do they do with it?
Instead of deducting that interest from their earnings today, they actually get to add it to the overall value of the asset on the balance sheet. They capitalize it.
Okay, wait. I think I have a really good way to picture this for you listening. It's kind of like Imagine putting a massive, let's say, $100,000 kitchen renovation on one of those promotional 0% credit cards.
Yeah, that's exactly it.
Right. While the promotion is active, while the kitchen is literally being torn apart and rebuilt, it feels like free money. Your monthly checking account balance isn't taking a hit at all. The cost is just quietly being added to your overall debt balance in the background. But what happens when that promotional period ends?
The monthly payments suddenly hit your checking account like an absolute freight train. And that is exactly what is happening to Alexandria right now, just, on a multi-billion-dollar scale.
Wow. Okay, so why is it hitting them in Q4 specifically?
Because they are finishing several of these massive construction and pre-construction milestones earlier than they originally expected this year. And the exact moment a project is done, or honestly, even the moment they decide to just pause a project and stop actively building, that interest can no longer be capitalized.
The promotion ends.
Exactly. The promotion ends, and that interest suddenly hits the income statement as a real, very painful cash expense. They actually expect their average real estate basis that's subject to capitalization to drop by a massive $2.8 billion from the first half of the year to the fourth quarter.
$2.8 billion? That is a huge swing.
It's massive. So that Q4 dip in FFO you mentioned, it isn't necessarily a sign that their core business is fundamentally deteriorating right now. It's just the cold, hard accounting reality of finishing projects. The interest expense is finally becoming visible on the income statement.
Okay, that definitely makes the FFO dip much less alarming. But let's pivot to the metrics that actually do show some pretty serious underlying stress. Let's talk about occupancy.
Yeah, this is where it gets tough.
Right. Occupancy dropped 80 basis points, landing at 86.9% at the end of the second quarter. And just to be super clear for everyone listening, a basis point is 1/100%. So an 80 basis point drop means their occupancy fell by 0.8%.
And look, 86.9% occupancy in commercial real estate, but particularly in a highly specialized, incredibly capital-intensive sector like life sciences, that is a flashing yellow light.
Yeah, it means over 13% of their incredibly expensive custom-built square footage is currently just sitting empty, earning zero revenue.
Zero revenue. And the financial impact of having that much empty space is staggering. Their same property net operating income, or NOI as you'll see it called, was down a brutal 10.6% for the quarter.
Wow. And on a cash basis, what was it, down 8.6%?
Exactly. Down 8.6%.
I really want to pause on this for you, the listener, because this is the divergence that actually matters. They hit their FFO targets, right? We just talked about that. But their same property NOI is actively bleeding out at roughly 10%. Why is there such a massive gap between those two numbers?
Simply put, because they measure two completely different things. FFO, it shows you the overall corporate picture. It includes everything.
Right, their development pipeline, new acquisition.
Exactly. The properties they just bought, the properties they just sold, all their management fees, their joint venture income. FFO is the aggregate health of the entire corporate entity. Same property NOI, however, is the true, unvarnished pulse of the existing real estate.
It strips out all the noise.
It strips out all of it. All the new acquisitions, all the fancy development. It looks exclusively at the buildings they have owned and operated continuously for over a year.
So it basically tells you if the buildings you owned yesterday are making more or less money today.
Precisely. And right now, those core buildings are making significantly less money. That 10.6% decline we mentioned is almost entirely driven by that drop in occupancy.
Because losing a tenant isn't just about losing the rent check, is it?
No, the mechanics of commercial real estate are brutal when a tenant leaves. Most of these leases are what we call triple net. That means the tenant is the one paying the property taxes, the building insurance, and the maintenance costs.
Oh, wow. So when they leave...
When a lab goes empty, Alexandria suddenly has to start paying the property taxes and the massive utility bills out of their own pocket just to keep the building from falling into disrepair. The margins just compress at lightning speed.
Now, to be fair, management did try to kind of cushion this blow on the earnings call. They were pretty quick to point out that the occupancy drop wasn't just this sudden, unexpected exodus of tenants fleeing the building.
Right, they have forecasted it.
Yeah. They previously disclosed that there were known lease expirations happening this quarter, and they claimed those alone accounted for the 80 basis point drop. But when you look at the other occupancy changes, the math gets really interesting because they actually had positive occupancy growth from signing new leases.
They did, yeah.
But then they entirely wiped out that positive growth with an accounting reclassification related to this massive campus in Andover.
Ah, yes. The Andover situation is just a perfect illustration of their broader strategic shift right now.
Break that down for us.
So they have this massive 160,000 square foot building in Greater Boston. Originally, the master plan was a heavy, capital-intensive redevelopment. They were going to turn it into a state-of-the-art laboratory or a biomanufacturing facility.
Which costs an absolute fortune.
A literal fortune. But instead of doing that, they pivoted. They signed a lease with an advanced technology tenant. And because they decided not to do that heavy lab conversion, the building was mathematically moved out of the redevelopment category and pushed back into the active operating pool.
Okay, I follow you so far.
But here's the catch. That new tech tenant's lease doesn't actually commence until the second quarter of 2027.
Oh, so it's technically empty right now.
Exactly. So for the next year, that 160,000 square feet just sits in the denominator of their occupancy calculation as empty, active space, which drags the entire corporate occupancy percentage down.
Wait, if it makes their current operating metrics look so undeniably bad on paper, why do it? Why take the hit?
Because it saves them millions and millions of dollars in immediate capital expenditures. By accepting a short-term hit to their occupancy metric today, they secured a guaranteed long-term lease without having to spend the massive amount of money required to build out a complex wet lab.
Okay, let's definitely dig into that. Because if their core properties are bleeding 10% of their cash flow, I want to know who exactly is renting space right now. The company reported a really solid 1,039,000 square feet of leasing volume for the quarter.
Yeah.
I mean, that is up 60% quarter over quarter, and it's up 9% over their historical average. Over 1 million square feet on the surface sounds like they are absolutely crushing it.
And honestly, on an absolute basis, over 1 million square feet in this current macro environment is a major achievement. It's also really worth noting that 75% of that leasing came from their existing tenant base, either expanding their footprint or renewing their current leases.
Which proves the stickiness, right?
Exactly. It speaks volumes about the stickiness of their specialized mega campuses. Once tenant is in, they don't want to leave.
Right. But, and there is a massive but here, when you look at the actual mix of who is signing those leases, the entire narrative flips upside down.
It really does.
Historically, traditional public biotech companies were the bread and butter for Alexandria, right? They used to represent about 21% of total rent. But this quarter, public biotech made up a measly 5.8% of new leasing.
Yeah, that is a cliff.
It's insane. The public biotech sector has essentially just stopped renting space.
And management was remarkably candid about why this is happening. They noted that, while venture funding in biotech has definitely seen some bright spots lately and IPOs have picked up slightly, the companies themselves are essentially in a state of paralysis. They are hoarding their cash.
Yeah, the founder, Joel Marcus, was incredibly blunt about the macro environment that's driving all this hesitation. He literally called the regulatory landscape, quote, a bit of a mess.
He didn't hold back.
Not at all. He specifically pointed to what he called a lack of expert leadership at major agencies like the HHS, the FDA, and the NIH, and he also heavily highlighted election year rhetoric.
Which is always a huge wildcard for healthcare.
Exactly. He argued that policies like Medicare for All are viewed as potential budget busters by the industry, which could completely disrupt the entire healthcare profit model. Now, I really want to be super clear for you listening. Regardless of your personal political stance on healthcare policy, whether you lean left, right, or center from a purely mechanical, impartial market perspective, when the CEO of the largest life sciences landlord on the planet flags the regulatory environment as a massive headwind that is actively causing tenants to freeze their expansion plans, you have to bake that into your risk model. We aren't endorsing his view, we are just telling you that it is moving the market.
Right. Because ultimately, the market hates uncertainty above all else. Whether it's, the implementation details of the Inflation Reduction Act's drug pricing provisions or leadership vacuums at the FDA, it just creates friction.
And friction is bad for real estate.
In the real world of real estate, friction equals delayed leasing. Think about it. A biotech CEO is absolutely not going to sign an ironclad 10-year lease on a $50 million facility if they don't even know how their lead flagship drug will be priced by Medicare in 3 years. They just won't do it.
Makes total sense. So if the traditional public biotech companies are completely frozen, where did that 1 million square feet of leasing actually come from? because somebody's renting that space.
Management basically found two massive new lifelines. The first is what they like to call the picks and shovels of the life science industry.
Ah, like the gold rush analogy.
Exactly. These are the companies that make the actual physical lab products, the testing services, the specialized medical devices. That specific sector drove almost 40% of their leasing volume this quarter.
Wow, 40%.
Yeah. But the second lifeline, and honestly the one that is arguably redefining the entire company right now, is advanced technology. That drove nearly 30% of the volume.
And this shift toward advanced tech, I mean, this is the central tension of this entire deep dive today. We're talking about AI companies, heavy infrastructure players, and advanced computing firms. But I really want to understand the physical mechanics here. Why on earth are AI companies renting space in buildings that were custom designed for biology?
It's a great question.
Like, what makes a life science building so attractive to a tech company?
It literally comes down to the physical skeleton of the building itself. A traditional corporate office building is essentially just a hollow shell with some basic air conditioning and standard electrical outlets, right?
Sure.
But a life science building, a true wet lab, is built like an absolute fortress. Because these labs use incredibly dangerous chemicals and need perfectly sterile environments, they require massive industrial-grade HVAC systems capable of replacing the entire volume of air in the building multiple times every single hour.
Right, because you can't just recirculate air if a scientist is working with a highly volatile chemical. You need a constant, massive intake of fresh outside air.
Precisely. And to support that massive HVAC system, you need an incredibly robust, heavy-duty electrical grid. Furthermore, the physical floors in a life science building are reinforced with extra steel and concrete to handle the immense physical weight of specialized imaging equipment, massive centrifuges, and huge liquid nitrogen tanks.
Okay, so take all those specs and now think about an AI data center or an advanced tech hardware facility. They obviously don't need sterile air, right? But they do have rows and rows and rows of incredibly dense, incredibly hot server racks.
Exactly.
So they need the exact same massive electrical grids just to power all the servers. And they need the exact same heavy-duty HVAC systems, not to clean the air, but just to blast enough cold air to keep the servers from literally melting down. Spot on. And they need those reinforced floors to handle the insane weight of the server racks themselves. The thermal management and power requirements for AI right now are just staggering. So Alexandria's buildings, they already possess the heavy power infrastructure, the high ceiling heights for massive cooling ducts, and the load-bearing floors that these tech companies are desperately searching for.
That is fascinating.
Yeah.
But this is where I really have to push back on management's whole narrative here, because they are spinning this on the call as a brilliant, proactive, strategic pivot to advanced tech. But let's be real, they bought these properties at top dollar during the boom to build high-margin life science labs.
It did?
And now they are straight up selling some of these premier assets at a massive loss. I mean, they took a $222.5 million impairment hit this quarter alone.
Yeah, that's a big pill to swallow.
$250 million. And the two biggest pieces of that loss were, first, a land parcel in San Diego that they originally bought to develop labs, which they are now panic selling to a residential housing developer because the lab market there is severely oversupplied.
And the other was an office building in Toronto that was supposed to be this amazing lab conversion, and they're selling it off because biotech demand in Toronto is basically dead.
You called this an ultimate defensive playbook earlier in the show, but isn't this just a catastrophic misread of the market? Are we really praising them for panic selling prime lab space to condo developers at a massive loss?
Look, it is a completely fair challenge. And honestly, praise might be the wrong word to use here. It is really more about an acknowledgement of stark reality. Yes, they absolutely misread the depth of the post-pandemic biotech hangover, particularly in these secondary submarkets like downtown San Diego, which is way outside of their core prime strongholds like Torrey Pines.
Right.
The initial investment there was absolutely a miscalculation based on peak irrational 2021 demand. However, the playbook aspect I mentioned, that is about how they are reacting to that mistake today.
Okay, explain that. In commercial real estate, ego is the ultimate enemy. Holding on to a dead thesis, refusing to sell an asset just because you don't want to take the embarrassing accounting loss on paper, that is exactly how development companies eventually go bankrupt. Acknowledging that a submarket is permanently oversupplied, taking the $222 million hit straight on the chin, and liquidating the land to a residential developer is a necessary act of capital preservation.
So it's about stopping the bleeding.
Exactly. It looks incredibly ugly on the income statement today, but it stops the cash bleed tomorrow. They are harvesting whatever cash they can physically get right now to protect the broader, healthy portfolio.
They actually used a very specific phrase repeatedly on the earnings call to describe this strategy. They kept calling it meeting the market.
Yeah, that was their mantra.
And the thing is, they aren't just meeting the market on these painful asset sales. They're doing it on their actual lease terms, too. To keep the tenants they currently have, or to attract these new tech tenants you were talking about, they are offering incredibly steep concessions. The initial free rent they are offering right now is averaging 1.5 months per year of term.
Which, by historical standards, is an incredibly high number.
Wait, let's just do the math on that. If an AI tenant signs a standard 10-year lease, Alexandria is giving them 15 months of free rent up front.
15 months of zero rent, yes. Now, management was very quick to point out that this is slightly down from a peak of 2 months of free rent per year of term in the prior quarter, which suggests the bleeding might slowly be stopping. But 1.5 months is still a massive concession. They were essentially buying occupancy.
Okay, but if you give away 15 months of free rent on a 10-year lease, you are effectively cutting your gross revenue by over 12% right out of the gate. Why on earth would any landlord voluntarily do that?
Because of the hidden costs of the alternative. And this ties directly back to why this pivot to advanced tech is so utterly crucial for their survival right now.
Okay, tie it together for us.
With a traditional life science tenant, giving away free rent is only half the battle. Landlords usually have to provide massive tenant improvement allowances, often called TI.
Mean what, exactly?
Meaning Alexandria literally has to pay for the physical construction of the interior lab space up front, out of their own pocket. Building out sterile clean rooms, installing highly specialized ventilation hoods, routing specific dangerous gas lines through the walls. They can cost hundreds and hundreds of dollars per square foot.
Wait. So they have to go out and borrow money at today's 7% interest rates just to physically build out a lab for a biotech tenant who, frankly, might run out of venture funding in 3 years anyway.
Exactly. The upfront capital expenditure is enormous, and the risk is high. But advanced tech tenants, especially these heavily funded AI and infrastructure players, they often want to invest their own money into the highly specialized computing infrastructure they need. Or, frankly, their build-outs are just inherently less physically complex than a wet lab.
So they don't need all the crazy plumbing and sterile rooms.
Right. So while Alexandria might have to swallow their immense pride, accept slightly lower face rents, and give away 15 months of free rent up front, they are saving an absolute fortune in immediate upfront cash by not having to build out the interior of a custom wet lab.
Okay, that is a fascinating mechanical trade-off. They are literally trading immediate rental revenue for a massive reduction in upfront capital costs. They are just choosing the path of least capital resistance.
Exactly. Cash preservation.
And when you look at the specific properties they are pivoting they mentioned 311 Arsenal Street in Watertown, where they have letters of intent for 109,000 square feet with advanced tech users, or 40 Sylvan Road in Waltham. These are buildings that already have the physical bones for tech, and they are leveraging that to save cash.
And saving cash is the absolute, undisputed priority for this management team right now, because they are staring down the barrel of a massive structural problem next year.
Which brings us perfectly to the management guidance portion of the call. We really have to talk about what the entire industry is currently calling the 2027 cliff.
Yeah, this is the scary part.
Management openly flagged that they have 1.4 million square feet of critical lease expirations coming up in 2027. This represents $100.5 million in expiring annual base rent.
Over $100 million just walking out the door.
Right. And here's the number that genuinely shocked me when I read the transcript. They conservatively estimate that it will take 12 to 24 months of downtime to release and outfit these spaces once the current tenants leave. Hold on, let me just process this out loud. They are going to have massive buildings generating absolutely zero rent for up to 2 full years while they pour more money into them.
It is a brutal, brutal reality of specialized real estate. When those 2027 leases officially expire, Alexandria immediately loses that $100.5 million in base rent. But, as we discussed earlier with the triple net leases, they also suddenly have to start paying the property taxes, the insurance, and all the basic maintenance on those empty buildings.
Yeah.
The cash flow swings violently, and I mean violently, from positive to negative.
But why does it take 2 full years just to find a new tenant? That seems insane.
Well, the downtime isn't just about finding the tenant. It is the physical, logistical reality of outfitting the space. First of all, the public biotech market is incredibly slow right now, as we know, so just marketing the space takes way longer. But second, even if they sign a tenant on day one, the moment the old tenant moves out, outfitting a specialized lab space or stripping a lab space all the way down to the studs to convert it for tech takes an immense amount of time.
Just the construction aspect.
Not just construction. You have to get fresh architectural drawings. You have to get highly specialized municipal permits for chemical handling or heavy power usage. You have to source complex HVAC equipment that might be heavily back-ordered globally. And then you have to actually do the physical construction.
Wow. And they actually increased their downtime estimate on this specific call, right?
They did.
Yeah, they previously told investors it would take 6 to 18 months, and they just casually bumped it up to 12 to 24 months. Management explicitly said they did this out of an abundance of caution, which basically means they want to see the public biotech sector fundamentally recover before they dare to assume these buildings will ever lease quickly again.
Exactly. By doing this, management is aggressively setting expectations straight into the basement. They are looking Wall Street dead in the eye and saying, listen, 2027 is going to be incredibly difficult for our operating metrics, and we want you to price that difficulty into the stock right now.
And dealing with that difficulty requires just an astronomical amount of capital. I want to run some math live here because the sheer scale is hard to grasp. They increased their estimate for operating asset leasing costs to a range of $1.5 billion to $1.65 billion.
It's a staggering number.
This is the money required just to release and physically build out the vacant space in their current properties. Wait, let me make sure I have this right. They have $100.5 million in expiring rent, but they expect to spend up to $1.65 billion just to get new tenants into the vacant spaces across the portfolio. They have to spend roughly 16 times the amount of the expiring rent just to stop the bleeding.
Your math is completely correct, and it illustrates exactly why life science real estate is currently so out of favor with generalist investors.
Yeah.
The capital intensity is just staggering. When you have to deploy $1.6 billion just to maintain your baseline occupancy levels and secure new leases, you need a flawless, bulletproof balance sheet.
Which brings us to the most critical existential part of their entire defensive strategy. Debt and leverage.
This is the whole ballgame.
Right now, Alexandria's leverage is sitting uncomfortably high at 7 times net debt to annualized adjusted EBITDA.
Okay, let's definitely break down EBITDA for the listener because it's a metric you will literally see everywhere in corporate finance. It stands for earnings before interest, taxes, depreciation, and amortization.
Right, which sounds like a mouthful.
It does, but it's actually simple. It is basically a measure of how much raw, unfiltered cash the core business operations generate before the accountants and the tax man get involved and muddy the waters. So when we say their leverage is 7x, it means their total net debt is 7 times larger than the raw cash their business generates in a single year.
And in a world where interest rates were at 0%, a 7x leverage ratio was honestly totally fine. Debt was practically free.
Nobody cared.
Right. But in today's interest rate environment, 7x leverage is terrifying.
It is highly uncomfortable, to say the very least, which is exactly why management is absolutely laser focused on their $2.9 billion asset disposition program. They are frantically attempting to sell off $2.9 billion worth of properties for one reason: to pay down debt. And they are specifically targeting nearly $2 billion in short-term commercial paper.
Let's pause right there. What exactly is commercial paper, and why is it so incredibly toxic that they are willing to sell premier assets at a massive loss just to pay it off?
Think of commercial paper as essentially a corporate payday loan or a very short-term IOU. It is unsecured short-term debt that massive companies use to cover immediate cash needs, like hitting payroll, or, in Alexandria's case, covering immediate massive construction costs.
Okay, so it's a stopgap.
Exactly. The maturity on commercial paper is usually measured in days or weeks, and it's rarely more than 270 days.
So it's not like a standard 30-year mortgage where your rate is locked in and you literally don't have to worry about it for decades. You have to constantly pay it back and immediately borrow it again. You have to constantly roll it over.
Exactly. You are constantly rolling it over. And when interest rates suddenly spike across the economy, the cost to roll over that commercial paper spikes immediately along with it. If you had a long-term mortgage locked at 3%, you don't care what the Federal Reserve does today. But if you have $2 billion in commercial paper that you have to renew next month, a high-rate environment can bleed you completely dry.
That makes total sense.
That is why they want it gone immediately. They want to eliminate that short-term interest rate risk completely and get their overall leverage ratio back down to a target of 5.6x to 6.2x by the fourth quarter of 2026.
And they ultimately want to get to the mid 5x range in the medium term. So let's look at the actual roadmap they gave us for this $2.9 billion sell-off. Because it's not all happening at once.
No, it's highly structured.
Right. They said 15% to 35% will come from land dispositions. So basically selling off raw dirt, like that residential play in San Diego we talked about, where they just don't see any near-term path to profitable lab development.
Right. And then another 10% to 20% will come from selling non-core operating assets that just don't fit the massive mega campus strategy anymore. They're pruning the edges.
But the biggest chunk, 50% to 70%, is supposed to come from sales of partial interests, meaning forming joint ventures where they sell a percentage of a property to a huge institutional buyer and other sort of complex capital strategies. And here is the major red flag they openly admitted on the call. The timeline for these sales is actively slipping.
Yeah, that was a tough moment on the call.
They noted that the weighted average projected completion date for these transactions has actively pushed into September. Now, they have 46% of the target, which is about $1.3 billion, either completed or pending with non-refundable deposits. And another 38% is, quote, in process. But they explicitly admitted that the joint venture transactions in particular are taking significantly longer because the buyers are actually struggling to secure their own financing.
And this is exactly where we see systemic risk actively bleeding into Alexandria's specific isolated strategy. Alexandria owns top-tier, absolutely irreplaceable real estate. But if the massive private equity firms and the huge institutional buyers they're trying to sell these partial interests to can't easily secure debt in this macroeconomic environment, those asset sales face severe, uncontrollable delays.
So even if the asset is great, the money isn't there.
Exactly. The actual gears of the commercial real estate transaction market are just fundamentally gummed up right now.
However, management was still adamant that they expect to complete the program this year. And they made a very specific, very shareholder-friendly promise. Their guidance assumes zero issuance of common equity for the rest of 2026.
Which is a massive, massive relief for current retail investors. Because when a REIT desperately needs to pay down debt quickly, the easiest, fastest lever to pull is just issuing new shares of stock to the public.
Right, but that dilutes everyone.
Exactly. When your stock price is already depressed, issuing new shares heavily dilutes the existing shareholders. It destroys your value. By formally committing to zero equity issuance, management is loudly saying they will fix this balance sheet through asset sales alone and not by punishing the current stockholders.
So they're effectively shrinking the company to save it. They noted their overall development pipeline square footage has actually shrunk by 20% since the beginning of the year. They're just finishing the buildings they already started. They are pivoting whatever they can to advance tech to save on those crazy build-out costs. And they are selling off everything else to build a fortress balance sheet before those massive 2027 lease expirations hit.
That is the absolute essence of capital recycling in a down cycle. You shed the non-performing weight, you reduce your debt burden at all costs, and you rely entirely on the strength of your core stabilized assets to weather the storm.
And to be fair to Alexandria, they do have a remarkably strong core, which actually brings us to the final part of our analysis, the bottom line. Let's look at the bright spots before we deliver the final talk ticker's verdict, because it is definitely not all doom and gloom.
No, not at all.
Liquidity is incredibly robust. They have $3.6 billion in total liquidity on hand, and they just successfully extended their massive $5 billion line of credit all the way out to 2032.
And that extension is a vital, vital piece of armor. It means that even if the commercial real estate disposition market completely freezes up, like even if literally no one can buy their joint venture stakes this year, they have the massive runway and the borrowing flexibility to survive without facing an immediate liquidity crisis or a catastrophic default. Furthermore, they actually boast the longest average remaining debt maturity of all S&P 500 REITs.
Which is huge. They also have a very stable tenant base at the very top. 57% of their annual rental revenue comes from investment grade or publicly traded large cap tenants.
Right. These aren't risky startups.
Exactly. These are massive multinational pharmaceutical companies with exceptionally deep pockets. They aren't fly-by-night operations that are going to vanish tomorrow. And across the whole portfolio, the remaining average lease term is 7.7 years, with average annual rent steps approaching 3%. So the rent that is locked in right now is really, truly locked in, and it is contractually growing every single year.
They also have 1.4 million square feet of space that is currently leased, but hasn't officially commenced yet. And when that space finally starts generating active rent, which should be around November of 2026, it will add roughly $69 million in annual revenue directly to the bottom line.
Nice.
which will really help cushion the blow of those upcoming 2027 vacates we talked about.
And they are consistently outperforming the broader market average occupancy in their three biggest markets. So in San Francisco, San Diego, and Boston, they are beating the market average by 8% to 12%.
Which basically just proves a fundamental rule of commercial real estate.
Yeah.
Even in a deeply depressed market, there's always a flight to quality. If a tenant is going to rent space, they want to be in Alexandria's mega campuses because of the operational excellence, the sheer scale, and the surrounding scientific ecosystem they provide.
Okay, we have dug through the messy accounting, the physical building mechanics, the massive capex, and the debt leverage. What does this all mean for you, the retail investor who is considering this stock today? We've got a company with uncomfortably high short-term debt right now. They are actively bleeding same property operating margins, and they are staring down a massive cliff of empty buildings in 2027 that will cost over $1.5 billion just to outfit and release.
Right.
But on the flip side, we have a management team that is aggressively, almost ruthlessly, pivoting to tech, shrinking their pipeline, selling off the dead weight at a loss to protect the balance sheet, and maintaining massive liquidity with top-tier tenants. Give us the actionable verdict.
The verdict is pretty clear. We are bearish in the short term, but this is a really solid hold for long-term believers.
Okay, let's break down the exact timing on that. Why bearish in the short term?
Primarily because the next 12 to 18 months are going to look incredibly ugly on paper. The same property NOI is already down 10%. As we move into 2027 and that 1.4 million square feet of space goes totally vacant, those operating metrics are going to compress even further.
The bleeding gets worse before it gets better.
Exactly. The company has to swallow 12 to 24 months of total lease downtime on those spaces. They have to deploy up to $1.65 billion in leasing capital, and they have to successfully execute the remaining $1.6 billion of their asset sale program just to pay down their commercial paper and get their leverage from 7x down to a safer 6x. The broader market is simply not going to reward this stock with a premium multiple while those core metrics are actively deteriorating and while the traditional public biotech tenant remains sitting on the sidelines just hoarding cash.
It's going to be a very, very tough pill to swallow for a few quarters, and the stock price will likely reflect that turbulence. But why is it a solid hold for the long-term investor who, say, already owns it?
Because management isn't hiding from the reality. They're aggressively adapting to it. If they successfully execute this $2.9 billion sell-off and reach their leverage targets, they will have built an impenetrable fortress balance sheet. But honestly, more importantly, their pivot to advanced tech infrastructure could fundamentally expand their total addressable market.
Oh, that's a great point.
Right. If it can utilize assets that are no longer viable for high-end biotech labs to serve the massive, insatiable infrastructure demands of AI and advanced computing, they position themselves incredibly well for the next real estate cycle.
Yeah.
You hold this stock if you believe management can execute the mechanical pivot and if you believe that the underlying urban mega campuses remain irreplaceable physical assets.
It really is a fascinating pivot. To quickly recap the core takeaway for you listening today, Alexandria is surviving a brutal post-pandemic biotech winter by leaning heavily into tech, shrinking its development footprint, and fiercely protecting its balance sheet by selling assets at a loss to pay off short-term debt. They are basically taking the agonizing pain today to ensure they survive tomorrow.
It is a really painful process, but it is necessary cycle management.
Which leaves us with one final thought to chew on as you review your own portfolio. We've spent this entire deep dive talking about how Alexandria is pivoting their incredibly power-dense urban life science buildings into AI data centers and advanced tech infrastructure hubs, right?
Yeah, the big pivot.
But think about the broader societal implications of that shift. If massive, power-hungry AI server farms are quietly taking over these urban life science mega campuses right in the middle of dense cities like Boston and San Francisco, what happens to the local power grids?
That is a huge question.
Are we trading a localized commercial real estate bubble for a regional energy crisis? Can the infrastructure of these cities actually handle having massive AI compute nodes embedded directly in their downtown commercial district?
It's a massive infrastructure bottleneck that city planners and utility companies are going to have to reckon with very, very soon.
Definitely something to keep an eye on. Thank you for joining us on this deep dive. Apply this framework to your own research, look past the headline FFO numbers, and always watch the short-term debt. We'll see you next time.